Northrop Grumman just printed prettier profit than cash flow, and the stock believed the cash flow. It's 2026-0421. This is Earnings Unscripted, and we're on Northrop Grumman, NOC, Q1 2026. The defense giant behind the B-21 bomber, missile motors, radars, the whole arsenal. Revenue was $9.88 billion, ETS was $6.14, and operating margins snapped back to 10% from 6.1% a year ago. Free cash flow, though, was still negative $1.82 billion, and after an almost 18% run through the quarter, earnings day was down about 6.6%. No clean Q4 P&L comp in the filing, so year-on-year is the honest read. Miro?
Good looking first, good second, complicated after that. The margin rebound is real, but some of it is simply the absence of that $477 million B-21 loss provision that crushed Q1 last year. So the income statement cleaned up fast. The market, I think, looked through that, saw cash on hand down to $2.09 billion from $4.4 billion at year end, and realized the B-21 capacity bill is just getting started.
And yes, personal opinions only, not financial advice, despite Miro's slightly unsettling commitment to backlog tables. So, okay, the numbers look better than the feeling. Why?
Because under the hood, it's uneven. Aeronautics was strong, sure, sales up 17%, and that segment swung to $305 million of operating income. Defense systems had the demand you'd expect in this environment. Sentinel, IBCS, tactical solid rocket motors, organic sales up 10%. Mission systems was quietly better on margin. Then space systems spoiled the symmetry. Sales down 3%, margin down to 9.5%, and a $71 million GEM-63XL charge after a launch anomaly. So bombers and missiles good, space annoying.
Space annoying is a very serene way to say 71 million disappeared.
Right, and Northrop gave you honestly one of the strangest little details of the quarter. To help accelerate B-21 production by 25% annually, they sold an aircraft they had planned to keep, a company-owned test asset, straight to the Air Force. That's both weird and practical, like clearing out your own garage so the customer can take delivery faster.
It's like selling your demo car so the factory can speed up, which is kind of incredible.
Exactly, and it tells you demand isn't the issue. Backlog sat basically flat at $96.6 billion after $9.8 billion of net awards, and they picked up a $1.3 billion glide phase interceptor contract right after quarter end. They reaffirmed the full-year sales guide, still pointed to, $3.1 to $3.5 billion of free cash flow, but raised 2026 capex to $1.85 billion for B-21 capacity. So investors are staring at this and asking, fine, what does the cash trough look like before the payoff?
And we don't have the exact street consensus, not in the brief anyway, which kind of makes the tape more revealing here. It gapped down and basically stayed near the lows.
Yeah. This felt less like a clean headline miss or beat and more like a quality of earnings shrug. Nice rebound, obvious demand, but the market is already pricing the next argument, supplier bottlenecks, bigger B-21 investment, and whether cash generation really catches up.
Yeah. All right. Let's open up the cash and capex piece because that's where this quarter stops looking tidy and starts getting interesting.
Yeah, because the uncomfortable part is this is not even the full capex pain yet. Q1 free cash flow was ugly, sure, but actual capital spending in the quarter was lower than a year ago. So the market is looking at a bad cash quarter and then realizing, oh great, the really heavy build hasn't even arrived.
Right. So the quarter's almost lying by omission. Not dishonestly, just temporally?
Exactly. The cash outflow this quarter was still the usual defense company cocktail, working capital, seasonality, and that debt repayment. But the guide is what matters. They lifted 2026 capex by another $200 million for B-21 capacity, and then the CFO basically told you the larger bill is later. His line was, we intentionally didn't give guidance on 2027 or 2028, and the $2.5 billion investment we're making, that will play out. The lion's share of that will be in 2027 and 2028.
Which is refreshingly blunt, actually. Not exactly investor candy.
No, and I kind of respect that, because the easy thing would have been to smooth it over and pretend this stays a nice, steady defense cash machine. Instead, they're saying, look, earnings can rebound before cash does. The P&L got relief from no big B-21 loss provision this time. The cash statement later gets hit by buildings, tooling, throughput, all the boring physical stuff.
the glamorous side of national security, concrete and invoices.
Yes, very cinematic. But that's the real story. Northrop is shifting from, can we stop losing money on early bomber production, to, can we physically build enough capacity without choking cash flow? Those are much better problems, to be clear. They're just not pretty problems.
Okay, but then that weird test aircraft sale matters more than it first sounded, doesn't it? Because that felt like a quirky anecdote in the opening.
It's more than quirky. It tells you the government wanted acceleration now, not in some abstract 5-year plan. Northrop had an aircraft it expected to keep as a company-owned test asset, and it sold it to the Air Force to support the new production arrangement. That is a very concrete sign the B-21 is turning into an industrial priority program. Kathy Warden called the deal a win-win, both contributing and both benefiting. And honestly, that sounds right.
So not accounting theater, more like, more like operational triage.
I'd call it operational bargaining. The customer wants a 25% faster annual production rate. Northrop wants economics that make that survivable. So both sides reshuffle assets and capacity. It's unusual, yes, but it also says confidence is high enough to start giving up flexibility for speed.
Which sounds good until you remember investors in this stock usually want a nice dependable drumbeat, not a wartime factory expansion plan.
That's the tension. Northrop is being pulled into something bigger than a normal quarterly cadence. Warden even framed the backdrop in almost historical terms, saying a 2027 defense budget at about 5% of GDP would be closer to Cold War levels than the 3% range of recent years. Once management starts talking like that, you're not analyzing just one quarter anymore. You're analyzing whether the industrial base can keep up.
And can it?
Not smoothly, I think. Demand looks real. That's not the issue. The issue is how fast you can convert urgency into delivered hardware. On the call, Warden said the Middle East and the conflict with Iran have created a heightened sense of urgency, and they're seeing opportunities move to the left. Great phrase. It means customers want orders and production earlier. But revenue does not magically move left if suppliers can't.
So move to the left sounds bullish on a slide deck, but in human terms, it means the phone is ringing faster than the factory can breathe.
Precisely. And you see that in missiles, too. They've doubled solid rocket motor capacity, and management still talks like demand is nowhere near satisfied. That should be bullish. It also tells you the bottleneck is now the ecosystem, subcontractors, materials, qualified labor, not whether the Pentagon wants the product. When a company says, effectively, we could grow faster if the supply chain would cooperate, that's opportunity and risk in the same sentence.
It's funny, these stories always sound abstract until you remember they literally built a prototype missile silo tube in March just to validate the Sentinel design. This is not software. You can't patch your way out of concrete.
Right. And that's why I think the market sold first and asked questions later. Not because the business looked weak, it didn't, but because the next 2 years start to look lumpy. You've got a bomber ramp, suppliers under strain, international demand accelerating, a space segment that already showed one launch anomaly can ding margins fast, and that F-35 radar line still has concurrency headaches. The room for execution error is not large.
So the deep read is this quarter wasn't really about whether demand exists. It was about whether Northrop can survive success without turning cash flow into a stress test.
That's it. Very good earnings optics, much more demanding industrial reality. I'm not bearish on the franchise at all. I'm just saying the story has moved from recovery to capacity discipline, and markets are much less patient with the second one.
Yeah. Profit said relax. The factory said not so fast. So where does that leave the stock and management credibility heading into the rest of the year?
I think credibility is actually all right. Not pristine, but all right, because they kept the bar up. They're still pointing to $43.5 billion to $44 billion of sales this year, operating margin in the low to mid 11% range, and Q2 stepping up high single digits sequentially. After the space hit and hired B-21 capex, that is not timid guidance.
Right. So the market isn't saying, we don't believe demand. It's saying, show me the industrial follow-through, which is a very defense stock mood, honestly. People own these names for steadiness, not surprise factory buildouts.
Exactly. The bigger theme is defense becoming a capacity story, not budget first. Sorry, not just budget first. Factories, suppliers, qualified labor, test cadence. Demand can accelerate faster than production, and that gap is where sentiment gets jumpy.
And I did think management earned a little credit for not ducking the awkward bit on the space issue. The CFO basically said, "We didn't pull off the guide on margin. That's refreshingly unperfumed corporate language."
Very aerospace. So next quarter, I'd watch whether that Q2 sales step up actually happens, whether space stabilizes after the anomaly, and whether supplier commentary sounds less strained. If those improve, the stock can calm down.
Plus, August lurking with FAAX. Not in today's base case, but absolutely in the market's daydreams.
Upside optionality, not something you underwrite. My simple take is this is a stronger franchise than the one-day drop suggests and a more demanding execution story than the EPS print suggests.
Which is such a Northrop sentence. Great machines, heavy cash appetite, zero interest in being easy to own. Fair.
A defense contractor, not a wellness app.
All right, that's a good place to leave it. Thanks for hanging out with us.
See you, everyone.
If you want these earnings chats to just show up, you can follow the show. And just so it's clear, this episode was AI assisted, built from the company's earnings release and call transcript rather than us sitting in a studio with a stack of printouts. And if there's a ticker you want us to dig into or something we got wrong or could do better, email us at earningsunscripted@datamadness.ca.